Thursday edition of the Not Your Average Investor Show, where we do the JWB Income Property of the Week. Today, we are reviewing a house that has positive cash flow from day one, and JWB offers a $2.4 thousand rent credit. Right now, we are getting ready to execute something on our own, Greg, and it is the Thursday edition of the Not Your Average Investor Show. We are live on Facebook for the JWB Rental Income Property of the Week. I am your host, Pablo Gonzalez. With me, as always, the man that they call GC because of his genius concepts that generate cash flow and because he's a great co-host. Also because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
It is great to be with you and everybody else as we have our community in the house already, man. Thursday, this is my favorite, man. We're happy to have you here, Lee Bishop. Happy to have you here. Eddie Harris from Hotlanta. John Henning, good afternoon. Scott Belote is back, and I now pronounce his name without error. Scott Belote. Welcome, Scott.
Teached.
Yeah. Bill Shields, Nadeem Shah. Who else? Mark Larrett is back again. Mark is one of our newest official regulars. Ken Moline, past star of the show. Leo F. coming from California with a patented good morning because it's morning for him while it's afternoon over here. And Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Saying manatees in the room today. Good to have you, Marilyn. This is awesome. As everybody here knows, if you've been here before, you know that Thursday in particular is all about you and all about your amazing questions for the POT dub that we call it, as Greg chimed in the chats. And there's two ways to interact. One way is interacting now in the chat with each other. So there's a little trick there. When you first open up that chat, it is defaulted to only talk to us. So you got to change that blue button that says panelists to panelists and attendees, and voila, now you can make friends with everybody else. And if you want us asking questions here live on show so that you can pick the brain of the GC right here, then you can perhaps make it to one of our famous Q&A segments that we publish after the show and be JWB Not Your Average Investor Show micro content famous. You want to use the Q&A box that is on the bottom right. You pop that open. You put the questions in there like John Henning has already done. And that allows me to keep better track of it, not go cross-eyed, and make sure that your questions get answered. I'm going to encourage you to pipe in early and often because we're going to, I bring them in as soon as they come on. And there's a certain point in the show where all of a sudden we got like 15 minutes left and 45 questions pop in. So the earlier you get them in, the better the chance that we get to them. But the other nugget here to offer you is that if you put them in the Q&A, our sales team, our customer service team, everybody gets to, we share that with them and they follow up with these questions or direct you to the right place. So I encourage you to use the Q&A for anything you want answered. And last but not least, if you want to fiddle with this Excel sheet that I'm going to be fiddling with on the call today, go to jwbinventory. Oh, I'm sorry. I'm still talking about the old thing. If you want to see the Excel sheet from today,
that's right.
Go to jwbinventory.com. That property is live for you to see. You can follow along live and you get the sheet so you can fiddle along with us fiddlers over here. Greg, are you ready for the first question of the day? John Henning coming in early. You ready?
Coming in hot. Let's do it.
Coming in hot. John Henning asks, your opinion on the rising cost of home insurance in Florida. Will the state act on regulation/law to help homeowners?
Well, let's talk about what I know and what I don't know. Will the state do what it is, what would help homeowners? I'm not really sure about any of that. I've heard a lot of things and I will defer to those who are much more involved in the conversations and the ideas and the legislation and all that good stuff. So I don't know about that. But what I do know is we are always one phone call away from somebody who does know that. And you are always one phone call away from somebody who does know that. That's our insurance team that all of our clients get introduced to when they buy turnkey rental properties with us. And so we have an incredible team. As far as rising costs, we have heard things mentioned. It is been mentioned here and there. Clients have been asking about it. What we feel largely is that right now there's not a change to the insurance costs. And I can say that because I look at the evaluations that we see that we put our insurance costs on for you to make sure that your return expectations are in line. And those are quoted in real time. Those are quoted like right before we go live with a property. So, and we're not seeing huge rises there. Many times when an insurance company, maybe on a renewal, comes back with a large increase, there are things that can be done when you have a wonderful insurance team that can come up with solutions to make sure that you're, number one, protected, and to make sure that the costs are in line. So I've been hearing things that people have seen these huge renewal numbers. And then we just rely on our team to make sure that we can take care of clients, to make sure, number one, they're protected, and make sure their returns are still in line. And I have all the confidence in the world that that's how it will go. There are some pressures out there, but again, there's pressures in every part of rental property investing right now. That's why you have to find a team who is very well qualified to make sure that they can come up with solutions for you. So we're not seeing huge increases to our valuations of the insurance costs. Your returns are largely in line of where they would be before, meaning prior insurance rates are very similar to what they are now as far as our valuation. So not a huge concern for us here at JWB as far as insurance costs.
Not a huge concern. Do you have any insight into the macro environment of insurance or anything you want to talk about there? Or is just kind of like stuff's just happening in cyclical fashion and we move on to the property?
I really haven't spent much time thinking about it. It's just not a huge concern for us right now. I know my team works really well with Ritchie Insurance Group, because we, just like with all of our partners, we want to make sure that as we're looking at an environment here where cash flows are going to go down, that returns are going to go down in the future, that we can make sure that we best serve those clients. Now, what can we do now to make sure the clients are best served and to make sure that cash flows are preserved as much as possible? So we have those conversations, but it's not something that I'm totally aware of. So I would probably defer to those insurance teammates.
Sounds good. John Henning, we appreciate the early question. We love answering them. Keep them coming, because if you don't, we got a whole bunch to talk about. And right now, we are going to magically whisk ourselves away here to 5353 Alpha Avenue, Jacksonville, Florida, 32205. Well, bam, we are there. We're looking at a $165,000 house that looks like it is a remodel, because it looks like one of these homes that have been around, and it's one story, and kind of like from what I see in color scheme of usual, this looks like probably existing inventory from before. 3-bedroom, 1.5 bathroom. It's got a driveway. Estimated rent between $1,125 and $1,175. And the star of the show, what you are actually purchasing when you choose to do business with JWB, is this total monthly cash flow in the estimated conventional financing of 166, and a total ROI on estimated conventional financing of 8.41%. Let's start where we always start, in the alpha part of the alphabet. Gregg, what does the total monthly cash flow figure represent?
Total monthly cash flow. Number one, you want to be in assets that are paying for themselves every single month. That means cash flow positive. And when you look over here, as Pablo is getting us, there we go, right in front of that, our face here is total monthly cash flow of $166 a month. What that means is you're buying an asset that has certain expenses with it. In addition to those certain expenses, you're able to take out debt, use other people's monies, incur those additional expenses from the debt, and the rental income still pays for itself, and then some, to the tune of an estimated $166 a month. And when you compare that to other assets, it's not normal to get recurring money coming back in. It's even less likely that you're able to get monthly recurring cash flow that you're able to offset the costs. It's even more unlikely that you're able to find an asset out there that has recurring cash flow that's able to offset the costs, that you're then able to leverage, incur additional debt costs on, and still have it pay for itself every single month. So that's what gets me so excited about buying assets, buying rental properties as an asset class. It's because there are these wonderful assets that pay for themselves every single month, including leverage, if you choose to use leverage. So the way that you actually get to $166 a month for estimated monthly cash flow, that's basically saying, what's it going to be like for a normal JWB client on a normal month? Meaning we're taking into account what's the rent that we collect, what are all the normal expenses that happen every single month, meaning your principal payments, your interest payments, your property taxes, your property insurance costs, and your monthly property management fees. Can't get away from any of those if you want this to be a passive investment, at least. So that $166 is what is left over on a normal month.
Got it. I like how you started there, man. So these last 2 days, my cousin was visiting me from out of town. He's a young entrepreneur with some cash flow, and he's like curious about real estate. And yesterday we were sitting out in the surfing lineup, and I'm talking about JWB like I always talk about when I'm surfing. And I'm trying to tell him about, I'm trying to tell him about all this. And he's like, yeah, but this, he's like asking me all these different questions. And I just kept going back to the listen, man, what this is something that pays for itself as it increases your options of doing stuff with an investment, right? Like I kind of kept like grounding back to that. So the way that you frame this as, yes, the cash flow is $166, but you've said this in the past before, what this represents is a scalable investment. The idea that real estate provides these different avenues later on, right? 1031 exchanges, cash out refinances, all these other different things that you can do to gain leverage on an investment. That's where I was trying to like start with him. So I love that, we always go down to the basics here on the POT dubs.
You know it.
Yeah, man. And we got a couple of great questions coming in the chat. I asked that if you joined a little bit late, if you can please put your questions in the Q&A box. It just helps me track it better because the chat moves really, really fast. And also, if the box above where you're typing says panelists still, you're only chatting with us. So for example, I know like Scott, I think you were just putting something in there that you wanted other people to see, and Rohit and a couple Justin, a couple of other folks in there, right? So if you can use the Q&A and share with everybody else in the chat, if you're so willing, that would be awesome. And apart from that, I will still try to get to it. Just, it makes my life a little bit easier. Last thing that we're going to ask here before we move straight into the questions, Greg, is difference between total monthly cash flow and this ROI number, please.
Yes. So the gross or the total monthly cash flow is slightly myopic. It's only looking at one of the 5 profit centers of rental property investing. And to make the best decisions for your money, to get the best risk-adjusted returns, you need to look beyond just what I call the cash flow blinders. Many investors just pay attention to cash flow. That's the only way they make their decision. And today, cash flows are lower than what they were in the past, as we've talked about many times here on the show. And guess what? 1 year from today, cash flows are going to be lower than what they are today. So we have been talking about all 5 profit centers here at JWB for over a decade. And it is never going to be more important for people to look beyond just the cash flows and to look at all 5 profit centers than right now and over the next coming year, because cash flow is only one of the 5 profit centers. It is not the only reason to invest in rental properties. It's like a threshold to get to. Make sure it pays for itself, then open up your eyes and your mind and look at all 5 profit centers. When you look at the total return on investment, we're looking at other profit centers here. So we're taking into account some of the extra good things, the extra profit centers, and we're also taking into account extra bad things, things that are expenses that happen at certain points in time. They don't happen every single month, but they happen at certain points in time, and they need to be evaluated as well. So on the positive side, we are taking into account your estimated tax savings. This is the taxes that you don't have to spend because rental property has such amazing tax advantages. We're also taking into account your principal pay down. This is your resident paying down your loan for you, which is incredible. It's why you'll wake up in 10, 15, 20 years, look at the loan balance, and it might all be gone, or it might be significantly less than what you have today. So you don't necessarily see that in your bank account every single month. But let me tell you, there's a real value to it, as I've been doing this for 15 years now. And so those are the good things we're taking into account. On the negative side, you need to take into account maintenance cost, vacancy cost. These are typically things that are either not taken into account at all or usually underestimated by investors, and they learn the hard way that doesn't work out well. There are maintenance costs that come along with this property. Your property management team is there to mitigate those risks, and we do a really good job of it, but they're there and they need to be evaluated. So the cost incurred for maintenance and vacancy are included there. You're also including tenant placement fees. Every time a new resident is put in your home, the property management company that you work with is going to charge you a tenant placement fee. Well, we want tenants to be in our home. We want residents to be in our home. So we need to incur that fee, and we need to put that into our evaluation. So that's there too. And then some other costs that you may not be considering, like closing costs, are important to put in there as well. So you take all of those extra good things that we just talked about, and you take the extra bad things, and that's where that 8.41% estimated return on investment comes from. And there's one profit center we didn't talk about here. Well, there's actually two profit centers we didn't talk about. There's home price appreciation, and then there's inflation hedging. But Paulo, should we just knock out the home price appreciation one real quick?
If you want to do it, Greg, first, I just want to say something. People are really impressed with how good your voice is sounding right now. I'm hearing Lee talk about your voice super smooth. I'm hearing Nadeem saying he took a Ricola before going on. I like the inside joke of your Barry White voice, and I could not stay away from that. But yeah, let's knock this out because I got some really good questions I want to get into.
I see him lighting up the chat. So thank you guys, and the Q&A. So thank you all. You guys all make this show. So the more questions you throw in here, the better the show is. So thank you there. I mentioned.
And thank you for your voice, Greg, because it really adds to the show.
You're welcome. You can record it and, put you to sleep at night if you want. I mean, who knows, right?
I already did.
So, man, where were we? Oh, we were talking about the profit center. So we talked about there's 5. We talked about net cash flow. We talked about tax savings, principal pay down. There's 2 other ones. On this evaluation, we built it in so you can take into account one of the additional 2. All right. So one of them is home price appreciation. We're going to talk about here in a second. Sometimes folks ask me about the 5th one, which is inflation hedging. You know what? That's a really big profit center. But, I find that it's hard for people to really kind of quantify and really understand and all of that good stuff when we're talking to inflation hedging. I could do it. We could put it in the evaluation, but it might do more confusion than help. So we don't even put it in this evaluation. Just know there's a 5th profit center, inflation hedging, that's not even in these numbers. But the 4th one is home price appreciation, and that's a big one. And so the way to think about home price appreciation is you have to understand that real estate works in cycles. I've started to invest in 2006. I found out what it was like in 2008 for one part of the cycle to happen in a way that's probably more exaggerated than we hope to ever see again. But the market crashed, and during the Great Recession, I've held on to those properties ever since. And would you know that if you took a 20-year segment, including that great dip, the Great Recession, what you'd find is that the average appreciation year over year in Jacksonville and in many other places in the country, actually that average year over year is very close to what the historical average is for your market. Many people don't know that, right? We dropped 35% in Jacksonville, and as of by the end of the Great Recession, dropped 35%. But if you look over the long haul, we've actually, in over a 20-year section here, we've actually appreciated an average rate of 4.3% in Jacksonville, and that's going from 2001 to 2021. And that 4.3% number actually is validated all the way back to 1990, because that's when we started to pull the data. The Federal Housing Finance Agency made it available. And that's what you can look to see at what your historical average home price appreciation rate is. The reason this is all important is because if you know that real estate cycles tend to repeat themselves, and you know what your historically accurate home price appreciation rate is, then you have some data, some insight that you should be using to make educated decisions on where you're going to be buying rental properties. If you are planning on holding on for a full market cycle, like I advise for all of our clients. So if you are in that camp, you're planning on buying and holding for a full market cycle, 10 to 20 year hold, you should be using this information. And so for us, that appreciation rate long-term in Jacksonville is 4.3%, like we've mentioned. And when you put that profit center in, boom. When you do that, your total return on investment skyrockets, and it skyrockets roughly 16%. It went up from about 8% to about 24%. Your market went up 4%. Your real estate value went up 4% a year, but your total return on the money you invested went up 24%. Went up an additional 16% just from the appreciation. Went from 4% of real values going up, 16% return on your money. And the secret there is leverage. That's why I'm such a big advocate for smart leverage. When you have real estate that goes up 4% in a market and you only put down 25%, that gain is actually a 16% return on your money. You add that to roughly the 8% that was there from the other profit centers, and that's how you get to a 24% return on investment.
Makes perfect sense. You always describe it as, you're putting in a quarter of the money of this investment, but you're getting paid on the entire part of the investment, right? So like that is the leverage that results. And, that's what took us from 8.3% to 24.04%. So really, really nice. It is something that for me has been profound to watch over and over. And it is what made me buy 2 homes in the last, or at least I'm working on my second home right now in the middle of that process. But all right, Gregg, I want to dive into some of these questions.
Cool.
First one is a deep dive. Rohit Srivastava. I'm going to say that better. Rohit Srivastava. Yeah, I think I got that right, Rohit. Let me know. He asks, how much is taxes and insurance on this? And he asked this because he did a calculation. With $1,100 as rent, $1,500 as insurance, and $2,600 as taxes, and 5% as vacancy, and 8% as maintenance, he thinks that this is actually negative cash flow. Can we do a deep dive into this, Gregg, and kind of break this down on where that, where that math is right or wrong?
Absolutely. Rohit, thank you so much for this question. This is going to be so helpful for everybody because I'm sure others might have a similar question. Let's start with the assumptions that you have. $1,100 in rent. Let me share with you what the real numbers are on this property, because when investors go into buying rental properties, many times they don't know this information. Many times they're taking educated guesses, or they're using what their realtor told them it may be, or whatever their source of the information is. It's usually not great. For us, for JWB, we care so much about giving you an expected rate of return and then showing up month in, month out, showing you what that expected return was, and then showing you actually what we do. It's called our client ROI report. So there's nowhere for us to hide. If I was to put out an evaluation here, I would only be making it harder on my client service team, who talks with you and meets with you monthly, when they show you the actual report later. And if I was to go way low on property taxes or property insurance costs, as far as an estimate, and the cost came in much higher, listen, you're going to talk to my team and you're going to say, hey, Gregg, why aren't I hitting 8.4%? What did we screw up here? And so there's no way to hide. This is why it's so critical to work with a property management company that is the same as the one that sold you the house, because goals are aligned. If you don't choose to do that, you're never going to have that line of accountability where the person who sold you the property, set the expectations with you, is the one who needs to show up month in and month out. So I certainly appreciate the question. And I'll kind of walk through what the real numbers are that we have on this property on Alpha here. So the first, did I miss anything there, Pablo?
I don't think so. I think you're on it.
All right.
Like I think it's just, like clarifying what the numbers mean. I think his calculation may have something to do with accounting for monthly things in a yearly way, or yearly things in a monthly way. I'm not sure, but if you can walk through the reason why,
yeah,
well, they don't add up to being negative, we're good.
Well, the numbers on the evaluation are just different than the ones that Rohit put in the question. So he estimated 1,100, I believe, on the rent. I'm kind of looking at the chat here. So he estimated
1,100 as rent, $1,500 as insurance, $2,600 as taxes, 5% as vacancy, and 8% as maintenance.
And Pablo, would you go and zoom in on the left-hand side there with the property information so we can show exactly what those numbers are here? So the numbers, the inputs are just different, Rohit. So in your example there, if it was exactly as you described there, I haven't run the numbers in my head, but I would imagine that it is negative cash flow. So, but the inputs that you have in your example there, they're just not the right inputs. So the estimated rent here is $1,150. This resident actually is already in place here. And we can talk a little bit about the rent credit as well, but just to keep it simple, the rent here on a monthly basis is actually $1,150, not $1,100. Insurance costs here, you had in your example had put $1,500 for insurance. It's actually $1,026. Taxes, you had put $2,600 as property taxes. The number actually is $23.12 is our estimate based on our experience in the area and also what this property has been taxed at in the past. And then maintenance and vacancy costs are actually lower than what you put in for your numbers in the example. If you look over and go to the right a little bit there, Pablo, you'll show where our vacancy rate and our maintenance rate are reflected. For vacancy, based on our performance with our portfolio of clients, which there are over 2,000 data points. We've sold over 2,000 houses. We have tracked every dollar in and every dollar out for maintenance and vacancy costs. Our percentages on vacancy are actually 3% of the rents. I believe you had mentioned 5% in your example. And then on the maintenance cost, our percentages are actually 6% of the rents. And I think you had mentioned 8, if I remember correctly. So just simple, different inputs. You bring up a really good point though. If you go and you try and buy a property and somebody comes in way low and then the numbers are a lot higher, then you might wind up with a negative cash flow situation, which is very common for normal outside of JWB rental property investing. That's why many people have a bad taste in their mouth about rental property investing. It's a shame, right? You don't normally talk to people who enjoy owning rental properties. And it's because all of the additional costs they didn't know right off the bat. So hopefully that clears up that question for you a little bit more. And if you have additional questions, please continue to fire those in. I'd love to get granular with the numbers. That's kind of why we do the property of the week.
Totally. Hey, listen, full disclosure, Rohit put that in private to us in the chat. And I was like, hey man, just share it in the thing. He's like, well, I don't want to be negative. We're like, no, man, let's shine a light. Right?
Yeah.
Like, so that's what this show is about, right? Like, let's please ask Gregg hard questions. I'm happy to stump him. So, all right. So another opportunity to dive into the numbers. Justin Levin asks, for the cash flow of $166, would that include 3%, approximately $33 for vacancies, and 3%, also approximately $33 for repairs? In other words, instead of cash flow being 166, would it actually be 100 when adding on those irregular expenses? And then he says, thank you for all the wonderful information you both provide each week. Thank you, Justin, for being here, buddy.
Yes, Justin, great question. And so the answer to your question, if you included maintenance cost and vacancy cost into the numbers for that total monthly cash flow number, it would be negative. Okay. So and that might've been Rohit's point as well. I see him putting another comment in here saying, Rohit said, I am using exactly the same number as yours with 3% vacancy and 6% maintenance cost, 10% property management charges, and I am getting a negative $55 a month. So you guys are right. You're absolutely right, right? The total monthly cash flow, the standard is on a normal month, is it going to pay for itself? We know that over time, bad things are going to happen to your property. Maintenance is going to happen. Vacancy is going to happen. The other thing that you guys aren't including here, which would also drive it more negative, would be tenant placement fees, right? Which are going to happen over time. So that's why you need to look at both of these metrics. You need to look at the threshold. The threshold needs to be on a normal month, right? A normal month does not have maintenance, does not have vacancy, does not have a tenant placement fee, right? On a normal month, it has to pay for itself. And that's what you see with that estimated $166 a month. If we were to lump on a whole bunch of additional costs that don't happen on a normal month, then your normal month would be cash flow negative. But that's not how these expenses work, right? If you had a maintenance cost and a vacancy cost every single month, that would be included in the total monthly cash flow number of that estimated $166. So that's why that's not included. That doesn't mean you don't have to factor that in though, right? Again, total monthly cash flow is here to see what a normal month is like for you, making sure that it pays for itself. You then need to take the next step, which is looking at all of the good stuff and all of the negative stuff that will happen, which is that total return on investment calculation. So just so everybody knows that these things are accounted for, that's right there in that total monthly cash flow, that total return on investment calculation there. You're taking into account your good things of your estimated tax savings and your principal pay down, and you're including all the bad things that can happen based on our actual performance now over 15 years, looking at those metrics, using those to estimate now for the future for you to hold this asset. And that's how we get to that 8.41% number. Hope that clears it up.
I think so. I think it did for Justin. He puts in the chat, I gotcha, makes way more sense now. This popped into my head as you're explaining this. Vacancy rate and maintenance rate are they even annual numbers, or are they just lifetime numbers, right? I think as you're describing this, like average monthly cash flow versus these percentages, it's not that you're dividing it into every single month. It's just like for the life of the asset, this is what it's going to cost. And then you extrapolate that for like 30 years or something like that, right?
Well, I think the answer is yes to both. Let me just kind of clarify how we get to that number there. So if the vacancy rate is 3% here, the way you would get there on an annual basis, if you want to see how much loss you would be expecting, is you take 1150, which is the rent, and I'm just using my old phone calculator. So if you want to follow along at home here, right? 1150 times 12, right? 1150 is a monthly rent. We want to annualize it. And then that comes out to $13,800. And if you want to see how much vacancy rate is expected, as this is what we have performed to, again, over 2,000 data points here, comes out to $414 a year. of vacancy cost. Now, how do we get it that low? Well, we sign long-term leases. We only sign 2 and 3 year leases, and we renew over 70% of our residents that come up for renewal. So our average resident stays over 4 years on average. That's how we get this on an annual basis. It's $414 on an annual basis. So that's how we get there.
Let me stop you right there. That vacancy rate, you calculated that against 12 months of rent?
That's right.
Okay. So maybe that's another thing. Maybe he's multiplying 3% times 165,000.
I think he's doing it next. If he's only getting cash flow negative of $55 by including that, he's probably using the monthly rent number, but he's just including this negative $414 and this is an annual basis. So if you wanted to see what it was on a monthly basis, right, that's $35. Okay. Of cost there. So
okay. So listen, rookie mistake. They both said that they're using monthly rent. Like I just didn't know.
Yeah. I love this. This is great. This is why we do the show.
Yeah, for sure. Okay. So Lee Bishop writes, rent looks in line with price. So why is there a $2,400 rent incentive on this property?
Man, so much good stuff to talk about with the rent credit. I thought I'd just kind of go full circle about how this property came to be. Let's start with the understanding that in this environment in real estate right now, inventory is hard to come by, right? If you are potentially working with other turnkey rental property companies, or if you are out there trying to find your own rental property investment out there, you're having a hard time because there is almost zero inventory on the market in almost every market out there. And I usually don't make broad general statements like that, but that's the reality. The inventory levels across the entire market, real estate, entire country here are low. And in some markets, especially markets that have been hot like Jacksonville, there's less than, I think it's going to be somewhere around 1 month of inventory when we get the new numbers here. And that's just incredibly low. So if you are somebody who wants to get into this asset class, it's harder for you to be able to find inventory. For a provider of properties like JWB, if all we did was buy properties today to serve the demand that we have for purchasing rental properties, we could not do it, right? Other people in other markets who do something similar to what we do, that's the inventory challenge that they're faced with. They haven't been stocking up. They don't have years of a runway of inventory. So now that they have more buyers than they have properties, they can't serve them. And that's why they go to a waiting list, right? So you have to, if you actually want to build this out to be an asset class for you rather than just a property here and maybe no more, you have to work with a provider who has multiple sources of inventory. So this is a great example of another source of inventory for us. JWB has 4 sources of inventory. We renovate properties, we build new construction, we work with partnerships that we have locally to source inventory for us. And the 4th one is we have our own company held properties. And we have over 300 now that we have held on to for many, many years. This is one of those assets that was in JWB's portfolio. And we bought these properties and then renovated them and then managed them for our own portfolio for many years. Part of that was because we love this asset class. Another part of that is how do we serve clients for this runway in the future? What happens if all 3 of those other things that JWB does to source inventory strike out? Well, we also have additional properties that are in our company portfolio that we can make available because they're the same type of property. They're in the same neighborhoods. Obviously, the residents are managed by JWB Property Management. So these are wonderful clients or assets for our clients. So this is an example of the 4th source of inventory for JWB. And I remember we were sitting in the meetings with my business partners a few weeks ago, and we said, hey, we're about to go and refinance this property on Alpha, right? Our loan that we had on Alpha was coming up. And in order for us to, we were then going to refinance the home. And we said, well, we've got some costs there if we're going to refinance. Why don't we make this available for our clients? And that's how this one came up. So that's a great example of how you're able to basically source inventory, or we're able to source inventory when others really can't. And it goes to the client to be a benefit because just flat out right now, very hard for you to find inventory any other way, unless you're working with a provider who thought about this years and years in advance there. Any questions on that, Pablo?
Nope. I think it's good, man. I'm just chatting in here with Rohit because we're going to go dive deeper into the analysis and conventional financing tab. But I was letting him know that if he wanted to download it on jwbinventory.com, he can download this thing and go into the analysis and conventional financing tab, which is here. And you'll be able to see all the different assumptions and all the real numbers that Gregg is talking about. But I wanted to, keep cycling through a couple more questions. So,
Absolutely.
Brendan, yeah.
Well, let me, because I didn't even answer the question. That was just
That's
my
right. You didn't answer the
that was my preamble to the answer, which I tend to do every once in a while.
The GC preamble. Go ahead, Gregg. So the actual question, just to get everybody on the same page, was the rent is in line with the price of the home. Why is there a $2,400 rent?
So all that being said, this one has been in JWB's portfolio since 2015. We've owned it. The same resident has been in that home since 2015. And for you as a client, this rent credit is an incredible value for you. For JWB, we've got a resident in there. And for whatever reason with our own portfolio, I don't have all the details about why we didn't raise rents at our normal way of raising rents, but the rent was under market for this client, really by a lot, to the tune of $200 a month. So actually, when the client who purchases this home sees the lease that the resident has signed, it's going to be for $925, right? So the actual lease right now is $925, right? The average rents over the future are going to be $1,150. Well, how do we do that? Well, what we do is we run the difference there and we run it over 2 years. And that becomes a rent credit that we give to the client at closing. And the reason we do that is because, number one, this now can become an asset that can be sold to a client. There's no way that we would be able to sell the client the asset if the rent was $925, because the property would not meet our criteria of delivering a 7 to 9% return. So what we say is, well, let's just give the difference in rent. Let's make that easy and give that as a rent credit to the client. Overall, they get it day one when they close on the property. So if you're thinking about this asset for yourself, envision having it be cash flow positive from day one, having a resident in there from day one, and then at closing, receiving a check for $2,400. That is now going to cover that difference for 2 full years of that difference for that home. So that's the real reason there.
All right, there you go. Brendan Rinner asks, if you have 50% down, 20-year at 7.5% for a leveraged investment, can you give me a sense of what you're seeing in the market? Down payment, amortization, and rates for rental properties.
And starting to get some awesome questions, and they're slightly detailed. So I got to pull up the questions here so I can look at it. So if you have 50% down, 20-year mortgage at a 7.5% rate for a leveraged investment, can you give me a sense of what you're seeing in the market? Down payment, amortization. Well, those terms are not nearly as advantageous as what you can get in the market for conventional financing. What you may be referring to, those terms sound like non-recourse financing to me. So I would just ask you, Brandon, just to throw in the chat or the question here, if you're asking me to speak on through the lens of conventional financing or non-recourse financing, I'm going to go ahead and do it through the lens of conventional financing. Those rates are a lot higher than what the normal lending market is bearing right now. There has not been a better time to understand smart debt and to take advantage of financing than right now. It's because rates are literally never going to be lower. You're already seeing rates start to creep up a little bit, and you're going to see interest rates creep up from there. But you're able to put down either 20% or 25% down. So not the 50% that you mentioned. Your interest rates, we estimate 4%. We know we can hit that for you. And so not the 7.5% that you had mentioned there. 4% is what clients are getting here for conventionally financed. And that's the expectation you should have there. And the other thing you mentioned was a 20-year term. Your conventional financing terms are all the way up to 30 years. And many of our clients take out 30-year loans. It actually gives you the best return on investment to do that and gives you the flexibility. You still can pay off your loan quicker than 30 years if that's the best thing for you, but many go with the 30-year loan. So, a lot better than what you're expecting if you're thinking about conventional financing.
All right, there you go. Brandon asked conventional. What are you seeing in conventional? So,
yeah, you're going to be so excited about applying for a loan right now if that was your idea going into it. So, and if you have any questions, again, reach out to my team. We haven't mentioned the way to set up an appointment with my team, but If you have specific questions, if you want to start the process of working with JWB, if you have questions about financing, you can go to chatwithjwb.com, bring that right up, schedule your own appointment, and get the ball rolling.
I put chatwithjwb.com in the chat. I also put jwbfacebookgroup.com in case you want to join our Facebook group. It's over 2,600 investors. I kind of brought that up because we have kind of been talking about this concept of not hiding anything, right? So if you want the real scoop of 2,600 people that know us, go ahead and ask any question you want in there, and it'll be answered by the group, and old GC pops in there also, right? So that is where we connect in between calls. Okay, great. Lee Bishop has another question. 1,488 square foot is a large house for the price. Because the house is a rehab and not new, that price is set here, right? So I guess he's asking, where does this price come from? And is his assumption correct about this being a rehab versus a new construction?
We'll take the easier one here. So is this house a renovation? Yes, it was a renovation when we bought it. It's continued to be renovated throughout. And basically anytime that we would sell a house that's in our own portfolio, the resident has been in there since 2015. So there's not been a major renovation since 2015. But we go through there before we would ever think of selling it to a client, and we do an inspection to make sure that this house is up to our JWB standard, to make sure that there is no deferred maintenance. This is actually a great time to talk about something that I didn't even put in the show notes or in the title of the show here. We talked a lot about the $2,400 rent credit. There is actually another credit that we're giving to the buyer on this one, and it's quite substantial, and it goes right in line with Lee's question here. The client who purchases this home is also going to get an $11,900 maintenance credit. $11,900 for maintenance. Pablo, does that sound quite large?
When I read that in the show notes, I was like, Greg, can I change the other property that I have a down payment on and get in on this one? Because $11,000 sounds pretty awesome.
So this is another example of us figuring out a solution to make sure that we can take care of a resident, provide additional inventory for the client, and be able to sell a property for JWB. Well, here, this $11,900, again, what I'm sharing with everybody, the client who owns this house is going to be cash flow positive from day one. They're going to get a $2,400 rent credit. Obviously, all the other good things that come along with investing in a rental property in Jacksonville, Florida with JWB are inherent in this evaluation. Why on earth would we also give an $11,900 rent credit? Well, it's because this home has been in our inventory since 2015, and we're not going to give you a house that has deferred maintenance. So I went to go and see, what is that $11,900 made up of? Well, what we determined is that we're going to put a new roof on this one. The house is in wonderful shape for the resident. They are clearly ecstatic about living there. They've been there since 2015. Hopefully we'll be there forever, but that roof is not up to our standard. So we do an inspection and we say, well, let's make sure that we do this. The other thing that we're going to do is we're going to put a hard surface of flooring throughout. It's going to be vinyl plank flooring. That's not what's in there right now. It's carpet. So now we realize that it's not up to the standard today of how we would sell a house, but this is a wonderful home for this resident to live in. Does it make sense for us to move the resident out, disrupt the resident, put a new roof on today before we sell it to you, put all new flooring throughout, have to move them into a hotel, do all that? No, it doesn't make sense for us to do that. We're going to do that on the next property turn, if and when that happens. And so that $11,900 actually is going to account for those costs that we will incur for the roof and the flooring. But for you as an owner, that can be used for any maintenance item between now and then. Obviously, it would just that you have that existing cost that will be coming, which will be the roof and the flooring. So hopefully we won't use that up, but that's there for you, for your experience, which is what I care a lot about is you're going to walk in this house. Again, cash flow positive from day one. You're going to get an additional $2,400 of rent coming to you because of the rent credit. And you're also going to walk into this not having a maintenance cost. Even if there's maintenance cost that's incurred, you've got this credit that's going to take care of it for a long time. And I hope this resident stays forever. So this is quite an opportunity. I know Lee had additional questions there though. What did I miss? It was how it's valued. Right? How this home is valued. Man,
well,
I don't think
before you get onto that part, because we're kind of hitting on other questions and so that we can skip them. Wrong Zoo had asked, can you provide info such as whether the roof, water heater, et cetera, have been replaced during the renovation? So no, roof has not been replaced. Water heater, this house has not been effectively, renovated in a while because it's had a resident in there for a really, really long time. So those things haven't been replaced. And then he also says, when is the last time the home was renovated? Do you know when the last time it was renovated was?
2015, before the resident moved in.
Right.
But
you said that at one point and I missed it.
yeah, no, but I want to clarify one thing. It doesn't matter if it was renovated in 2015. When we go to sell the house, we maintain the same standards for all of your major mechanicals throughout the home. So as we were going through that same process before we would offer this home to a client, we went and we looked at all of those things that you just asked about. And I believe that's a new name. Wrong. I appreciate you being here. So wonderful question. So we have all that information that's available for our team to share with you. You know, obviously, as you reach out to my team and kind of go through the client onboarding process, that's there before the property decision is being made. So that is there for you. And it's always up to our standard, right? And if it's not up to the standard, we're either going to replace it ahead of time, which we would have done even before we offered it to you, or in this case, it makes more sense for everybody to issue it as a credit that will, of course, reduce the cost in the future when we would do the work for you.
All right. I've got a question that I think might be a smart guy question that I don't know if it's true, but when you're giving that $11,000 credit for putting in a new roof and putting in new floors, will the need to put in a new roof and new floors extend the vacancy, right? Like right now, you guys are moving people out and moving in like 2 weeks. I would imagine that it takes a little longer than that to put in a new roof and new flooring and also get it rented out. Do you think this extends the vacancy? Is that taken into account?
I don't see that being something that would move the needle on this home at all. It's not like I would raise the vacancy percentage because you might have a few extra days of the roof. You know, our average property turn was actually just in the quarterly meetings. It's 11 and a half days from us to go from the time that the resident moves out to the time that we have it available then on the market. It's 11 and a half days. So, you know, I just don't see that moving the needle just because you have a larger roof or you have a roof repair, you have floors. I mean, my team's really great. I don't think that moves the needle.
Okay. Doesn't move the needle, but smart question. Was it a smart question?
Wonderful question.
All right. Good. Good.
Yeah.
All right. So now tell Lee answer Lee's question for Christ's sake.
Sorry to, not give your credit or your question the credit that was due. I'm giving everybody else. I love all the questions. You know what? And I forgot to say thank you to you, Pablo. Thank you, Pablo, for that wonderful question.
You're welcome.
Let's go to how the house is valued. So houses are always valued the same way. It's based on comparable sales. Whether that's a renovation, whether that's a new construction home, it's based on comparable sales. And so that's the way that this is valued. So comparable sales take into account how large the home is. It takes into account what other features the home may have. That's what an appraiser does. It looks at what house is sold in a small area around, what house is sold recently that is comparable to your property in terms of square footage and other features. They determine what that value should be. So that's the same as always. So there are other homes that are comparable to this one that have roughly the same square footage that have sold in the last, 6 months that appraisers look at and come to that same value of 165,000. Is that the one here? I believe it's 165. Yeah, there we go.
Miguel Ducase has a question here. Just tuned in. What's the minimum down payment, closing, etc. on this property? Is it 33,000? That's his guess. Should we go into the tab?
Yeah. And again, for everybody, and I know you just joined. So for you, you can always kind of, join along and see the actual evaluation by going to jwbinventory.com. The vision for Pablo and I is that you guys are all following along at home and messing with the evaluation just like we get to do here and putting your own inputs in and things like that. So make sure you take advantage of that. It's available for you at jwbinventory.com.
Yeah. And Greg, the term is fiddling with the sheet. That's how we talk about it.
We don't mess around. We fiddle.
There's no messing. We're fiddling. All right. Let's talk about it.
So the question was minimum down payment. So for us on our evaluations, we're conservative, right? The down payment you see there is 25% if you're looking at, row H there. Pablo, if you wouldn't mind putting the cursor on that one. There we go. Yeah. So 25% is the down payment that we have built into this. There are a number of reasons why we do that, but at the end of the day, it is a more conservative approach to giving you an expected return on investment. You're going to see here in a second that if I drop this to the actual minimum that you can put down, which is 20%, your returns without me changing anything else are going to go up. So what that should communicate to you is if you want the highest return on investment, 20% down should be something you consider. And my team is here to talk through that with you. It's not always as simple as that, but hopefully the point is there that number one, JWB is conservative. I'm not interested in just putting the highest possible return on investment out there that I can because my goals are aligned with you. I want to show up and actually hit this return on investment. And then also because the returns really stand on their own 2 feet, and we don't have to go supercharged. What's the best that we could do ever? So you've got 20% down is $33,000. You can see that in column L there. If you want to highlight that one there, Pablo. Perfect. Yeah. So yeah, down payment's $33,000. Don't forget about estimated closing costs. So that's that $4,125 as your estimated closing cost. You know, people again they just don't know to include this in their return numbers, or they don't know what their expected closing costs are going to be. And it's one of the reasons they have a poor experience buying rental properties. You're going to see that here. So your total investment at the bare minimum on this one should be around $37,000 out of pocket.
There you go. So let's put this back to 25, go back to the average assumptions, go back to the summary, and we're good to go to move on. Gregg, speaking of moving on, do you have a little bit of extra time today past 1:30? Do you got to get back to those manager meetings?
I'm done with the manager meetings, but I'm training a new teammate here at 2. So I probably got to maybe like 140, 145.
All right, let's fiddle.
Okay.
Okay, real quick. Benedicta Giwa asks, how long have you been in business? How can I get involved? And do you have multiple investors per property?
All wonderful questions. Benedicta, thank you so much for joining us. We started the company in 2006. So we just celebrated our 15-year anniversary. How to get involved.
How do you get involved?
The easiest thing is to go and chat with my team. Go to set up your own time to speak with us at chatwithjwb.com. You can go right there, schedule a time, jump on the phone with my team, and they'll be happy to get the ball rolling. And do we have multiple investors on one property? No. You're going to be able to buy one asset for yourself. You're going to be able to own it yourself. For JWB, we sell the asset to you. You own it 100%. And then we are your property management team who is going to manage this asset for you for the lifetime of your investment.
Beautiful. All right. We got 2 more questions. We're going to hit back to Rohit, and then we're going to dive into the numbers so we can do that deep analysis. Eddie Harris from Atlanta asks, available homes for rent or purchase are down in Jacksonville and all over. When JWB starts building more homes, is there a target price for the new builds?
Great point. That available homes for rent and for purchase are definitely down. Supply is low. We are focused on building as many as we can right now. That fits, of course, in line with our capacity here. This year, we're going to be building somewhere between 450 to 600 new starts this year for new construction. So it is a big part of what we have believed in for a long time, and an even bigger part of what we do this year and will be in future years. Big believer there. When we go to price new construction, there's a lot that goes into it. We don't have a target price. We have a target return on investment that we're always here to hit. And you've seen me reference this return on investment conversation multiple times today. That's how we think. That's how we would ask you to think if this is going to be a great fit for you to get in this investment class. And that's why we start the show talking about monthly cash flow numbers and total return on investment. That's how we think. So we price the asset to make sure that it can hit those return requirements. And generally, right now, the market is bearing 7 to 9% returns, not including home price appreciation. That may change. That will change. I don't know when that will change. But what you're going to see is as interest rates go up in the coming months and years, and as home prices go up, especially over the next year, you're going to see that cash flows are going to be compressed, and that 7 to 9% estimated return number will come down. I have no doubt it will come down, because rents are not going to keep up with the additional costs incurred from home prices going up and interest rates going up. So, but that's how we price it. We look and see, okay, what can we return for a client? And then how do we always make sure that we're selling it at market value? There you go.
Beautiful. Rohit Srivastava, I get it this time, asks, it is estimated that housing prices are almost as high as before 2008, and there is an expectation of a crash. What is your opinion on that?
Wonderful, wonderful question. I'm sure that's on the minds of everybody now, and it will continue to be on the minds for a long time. To your data point, home values are higher than 2008 is very real, right? But we need to think about real estate in cycles, right? The fact that home prices today are higher than they were in 2008 should not surprise anybody, because real estate is a hedge against inflation. And if you look over time, it generally goes up every year similar to what the inflation rate would be. And many people assume it's about 3% for inflation. And that's about what the rate of appreciation is on real estate year over year. So if we're in here in 2021 and home values are higher than they were in 2008, it shouldn't surprise anybody. Like that should be happening, right? That's built into real estate because it's a hedge against inflation. It's a hedge against inflation because as the cost of goods and services go up around real estate, home prices of a physical asset go up as well. So you're right that home prices are higher than 2008. Does that concern me? No, not that individual data point doesn't concern me at all. Two things that I would look at to see if you feel like that I look at to see if we are in a bubble, if prices are going to fall off a cliff, because I know what that feels like because I started to invest in 2006. I put all of my money and all of my parents' money and all of my business partner's mom's retirement account into buying 40 rental properties in 2006 when I was like 22, 23 years old. And then I saw the market crash in 2008 and I clearly was scared about it. And I know how that felt. Two data points. You want to see what the actual home prices are compared to the median home expected price. Okay, right now, your pricing in Jacksonville is right in line with what the median expected price would be. That doesn't mean that, well, let me say, the median expected price means that in Jacksonville, home prices go up about 4.3% per year, which has been validated over the last 30 years. And you look and you say, well, if that continues to happen, what are prices today? If you were to see that home prices today were way higher than what the median home price, the median expected home price would be, that would be a sign to me that we'd be in a bubble. So in 2006, if I had the graph to show you here, that's what you would have seen. The median home price was here. The expected home price was here. The bubble 2006-7 was up here. So you don't have that today. You're in line. So that doesn't concern me, but that would be something to pay attention to. The other thing to look at is months of inventory. This is where you measure demand versus supply. In 2007, which is before the Great Recession, or as that was starting to happen, months of inventory was at a number of around 18 months of inventory. An equilibrium market in Jacksonville is between 6 to 7 months. And what this is measuring is the amount of months it would take to exhaust the supply of homes on the market. 6 to 7 is an equilibrium market. If you're at 18, that is such an absurdly high number. I've never seen it that high or get anywhere close to that. That means, we had 16,000 houses on the market in Jacksonville at that time on the multiple listing service. We only were selling like 900 a month at that point. It is such a buyer's market at that point because there are a million houses on the market and nobody's buying, right? When that happens, that is an indication that home prices are going to drop. So now the complete opposite. I have never seen it this low. We have been talking about it for years now. It's been in the 2 months range to 3 months range. Now it's under 2. I think that the number is going to come in somewhere around 1 month of inventory, which is crazy low. And what that indicates is higher than normal home price appreciation is expected in the short run here. But these are the two things that I'm going to continue to reference over and over and over again. I've continued to reference those for the year plus that we've been doing the show. That's how we were able to navigate and guide our clients through coronavirus, through COVID, and what was the best thing to do with your money. We looked at those two metrics. So as this question continues to come up, let's continue to reference those two data points. It's not going to tell the full story, right? There's other things that we have to take into account, but those are two leading indicators that make me feel really good about home prices going up in the short run.
Yeah, real hit. And, I know that you've only been around here for a little while, but when we were hosting this show, when coronavirus hit and everybody was freaking out, I remember we had kind of just started the show. And I remember Gregg coming up and starting to introduce this months of inventory. And he's like, I don't think things are going to drop. Like, I can't say that they won't go up, but they won't drop. And what has happened is just like record breaking appreciation because of that whole, months of inventory thing. I want to add a little context here because Margaret Smith writes in the chat, scared is an emotion. What did it actually cost you, Gregg, in that 2008 crash? Did you have to pay out of pocket to keep these things going? Did you sell some at a discount? Did you hold on somehow? How? Right? Like, go take us back to 2008. What was going on?
Thank you for the question. This is the beauty of owning rental properties, what I'm going to talk about here. Okay. 2006 to 2007, my business partners and I bought, call it 40 rental properties. Those rental properties were cash flowing every single month, just like I'm working with you all to help you invest that same way. Why do I call this the threshold to accomplish? It's because on a normal month, you need your assets to pay for itself, right? Only after you get to that threshold do we start to look at the other profit centers. Well, when I bought those rental properties in 2006 and 2007, I subscribed to the same theory. I bought assets that, a couple $100 a month were positively cash flowing every single month. Now, what happened in 2008 to 2011 as home prices dropped 35% scared me because I had never been through that before. But I knew how to invest in rental properties. It was to make sure that they were cash flow positive so that I didn't have to bank on selling the properties in order to receive a profit from them, right? This is the core of why this asset is the best risk-adjusted return on investment, in my opinion. It's because it pays for itself every single month. So what happened was, to answer your question, no, I didn't lose money on those properties. I was able to hold on to those properties. And I didn't have to throw a whole bunch of new money into those properties. It's because of all those 40 properties, they were all cash flowing, $200 a month, call it, just to make it simple. And so people need to understand there's a real difference between home values dropping and rents dropping. Rents did not drop in 2008 during the Great Recession, 2010, 2011. I was still able to hold those properties, even though I was a young kid with a fledgling business at that time, who did not have loads of cash, did not have a rich family to help me out. It was because of this way of investing where you have to buy assets that pay for themselves. That was the secret. And so the other part of it was a buy and hold mentality. I knew I was going to hold on to these things for forever. And I've continued to hold on to those for forever. That's why we've built up to now we own over 300. Those 40 are still in the portfolio. And I didn't have to do anything special. I just had to buy it right, make sure they were positively cash flowing, have wonderful management in place, and just let it go. I didn't freak out. I didn't sell all those assets. I didn't need to. They were part of my long-term retirement plan anyways. And so this is the opportunity that you have with rental property investing. Like I'm not a huge risk taker. Like I'm a conservative guy. And this is the reason that I quit my corporate job and put all of my money and my family's money into rental property investing at that time. It was because to me, it made sense that even if the sky fell, that the rents coming in were going to be there to make sure that I wasn't going to be in a bad financial spot. So that's part of the reason why I love this investment.
You are not a very risky guy.
No. Talk to my business partners.
I'm just going to throw this out there. Rohit, I thought that we were going to have enough time to like really mess around inside, fiddle around inside that analysis conventional financing tab. I don't think that that's going to happen, but I encourage you to come into the Facebook group and dive into the numbers and whatnot to like keep proving or disproving your assumptions. We'd love to keep doing that. So, but I got a couple more questions here before we let you go, Greg. Justin Levin asks, even though each property is different, what are the typical closing costs that you should expect as a new buyer when purchasing a property?
So the way that we can make sure that you have great expectations going in is we're able to look at all of the closings that have happened, call it over the last 6 months. My team routinely does this to make sure that our expectation that we set are the expectations we set are in line. So that's how we get to roughly 2.5% of the purchase price is that's how you get to that closing cost number. And what's that made up of? You've got origination fees, you've got doc stamps and title costs, and what you have to pay the attorney's office to close the loan or to close the property. So it's made up of a number of different things. But for me, what I pay attention to is what's that total cost going to be? How's that going to affect my return on investment? And that's how you get that 2.5%. Now, that doesn't include every number that you may need to bring out of pocket to close the property too. We haven't talked about this, but this would be kind of cool to share, right? So when you actually close a property, your lender is going to require additional months of prepaid taxes and prepaid insurance. A lender does this to protect themselves. Like for example, if they didn't collect this in advance, then they might have more risk that your property doesn't have the property taxes paid or the insurance on the property. And so they collect additional months, and it might be between 3 to 6 months or a year for insurance, whatever it is. So there might be additional costs that come up beyond the 2.5% that we put in there. There might be less costs. The reason why, if there are additional costs, it wouldn't be reflected in your returns is because if you're prepaying taxes and insurance, that's already accounted for elsewhere in the evaluation, in the taxes and the insurance on an annual basis, numbers that are in there. So it's all accounted for there. Timing may be a little bit off. You may have to bring more than 2.5% down to close the property. These are all things we share with clients throughout the closing process. In fact, from the time that you'd reach out to my team to the time that we'd actually be looking at properties, usually is a slower process. We do this on purpose to make sure that you have all the right expectations. You're not surprised. We explain all this good stuff, but that's how we get there.
Right on, man. Right on. I got last two questions, Greg. Number one is Michael Madonia. This is a new name that I don't recognize. Welcome, Michael. Can you give some context to the rent? Most of your properties seem to rent around $10.50 to $11.50. Not being a Jax native, it seems high for C neighborhoods. Is that just the average rent in these zip codes, or would you say JWB houses are at a high standard than most homes in C neighborhoods?
This is what the market is bearing. So just like the question as far as how do we price the homes, and it's based on comparable sales in the area, it's the same methodology for pricing rents. And the wonderful thing is because we're so locked into our core neighborhoods, there's 4 neighborhoods in Jacksonville that we just tend to dominate here. We're so locked in. We have rental comps that are numerous, right? I know this house is on Alpha. This is in 32205 in Murray Hill neighborhood on the west side of Jacksonville. There are probably 50 other homes that we manage within a half mile to a mile radius here that are all very similar because we tend to do the same thing over and over and over again. So for us, we have this incredible knowledge. We manage over 3,700 homes here, and we're only in Jacksonville. So the depth of knowledge that we have on rents is substantial. And so we just simply look to see what other homes are renting for. This is even more important today that you work with a partner that has that depth of knowledge, because guess what's happening to rents? They're going up, right? They're going up. You want to make sure you work with a partner that is there to capitalize on that. Now, number one, we want to make sure that your resident stays for a long time. That's the number one thing that we need to do, because that's going to affect your returns more than anything. But we also want to capitalize on rents going up. Well, when you work with a company that has 3,700 data points there, that is renting hundreds of homes every single month and moving residents in, they are going to be the first to spot an opportunity for you to get an extra $25 a month in rents. Or when the renewal comes up, they're going to be the first to know what's that opportunity to renew that resident and get a rent increase. So that's really, really critical. And then let me put this in context too. That's even more critical today because we're facing an environment where cash flows are going down. Like in an environment where prices are not going up and interest rates are not going up, you can make an argument this is less critical. But right now, every property management company, the partner that you work with, needs to be so focused on preserving cash flows for you. And this is one way that we can potentially increase rents when necessary, increase rents on renewals when we can. That's another way to basically preserve cash flows for you.
Really well answered, Greg. Going to send you off. Last question from one of our favorites, Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Is this home currently for an investor to purchase? Has it been sold? Is it available, Greg? Can I get this $11,000 credit, please?
I'm going to look it up on my phone right now. I didn't look it up before the show, but I'm going to get you an answer here in a second.
All right, cool. Listen, while you are looking up this answer, I want to thank everybody for joining us. We had over 40 people on the call today for over an hour in the middle of a Thursday. That never goes without noticing for us, that you spend your time, valuable time in a weekday. Really, really appreciate you showing up and making the show what it is. These Thursday shows really are like our family all hanging out, all us friends hanging out. This Tuesday, as you know, we do POT dubs on Thursdays. Tuesdays, we got interviews. This Tuesday, we're going to get the elusive Alex Safakis, co-founder of JWB, Gregg's best friend for life and college roommate, who is also the reason why JWB is so vertically integrated, because he is on multiple boards downtown. He makes many, many decisions, that he influences many decisions in the public sector, and he's always keyed into what's going on. He's going to share with us Jacksonville secrets. We're going to pick his brain on what his actual perspective is on the decisions that are being made, the true insider real estate player information of Jacksonville from the insider of Jacksonville, Alex Safakis. And Greg, are you ready? I've been teasing Tuesday. Like we said, go to jwbinventory.com, download the sheet, join us in the group, jwbfacebookgroup.com. I'm super happy to have you all here. Greg, I'm going to give you for final word on if this house is available and final word on the call. And then we Audi 5,000, my friend.
That was wonderful. Well, first of all, thank you all for being here. This is incredible. This home is currently under contract. So a client did pick this up. Don't be surprised when this happens. I've never seen homes sell more quickly than they are right now, but don't be discouraged. Literally, we have inventory that's very similar to this. So if this property piqued your interest, if you like the model, start to think of these properties as widgets, right? These properties are interchangeable and we have inventory for you. As long as you buy into the model and the team and the market, you're going to be in a good place. We have inventory available. So if you're interested, reach out to my team and there will be another property that's very similar to this. Go to chatwithjwb.com. And thank you all. We will see you on Tuesday. Take care, everybody.